Hey everyone, my name's Andy. My channel is Finding Value. If you're a new subscriber, welcome to the channel. If not, you know what to do, leave some comments. I have a ratio update today. I'm going to go over some ratios. We're going to jump right into it. So this is a ratio update. So an overview, we're going to look at the HUIs, which is the gold bugs index to gold ratio, and compare it to a current ratio. We'll look at all the other ratios to see if they're telling us anything. We're going to look at the 10-year treasury yield, the dollar index, and some real estate information about housing starts. So this is the HUI to gold ratio. And I just wanted to go over this real quick with everybody. This is where we're at. We're at 1.62. So we're right in this area down here, in this kind of jumbled area. I'm expecting this to pop up pretty high. Now this isn't my chart, but I expect this to come up pretty high at some point. We'll have another big run at it. And then we're going to have to swap our gold stocks to gold itself. It says realize profits and swap it to gold while we ride the gold price higher and as the gold stocks fall. This happened from 2000 to 2004, and this is just a chart that we're looking at that they charted. It fell all the way back down to these lows down here, and I expect it to go up, and maybe it hits this peak, maybe it doesn't, but I expect it to contract. This is the HUI to gold index real time. We're at 0.162. Looking at this chart, we're down here right now. And I expect this to really run up with the price. They say gold is going to be around 2,000 to 2,300. It's probably going to be a little bit higher than that. I think 2,500 to 3 grand is probably where it's going to be. And then we pop out and buy gold itself. So that's one strategy. This is the Dow to gold ratio. We're still in this large channel. It looks like it popped out and then came back in the channel. So we'll see what happens here. We'll continue to monitor it. What we want to see is gold outperforming the Dow. We want to see this actually go down. So right now it popped up. Now we're back in the channel. This was that day that they released a bunch of news. They pushed gold down with this news and they propped up stocks. I don't think that's sustainable, and what I think is going to happen over time is that gold's going to outperform the Dow. That's what it's done in the past, and that's what I think is going to do in the future because of the market conditions. Here is the gold to silver ratio. You can see a couple of chart patterns breaking down, going down. What this means is when this goes down, silver's outperforming gold. We're right at the bottom of the channel right now. We're just barely clinging on, which makes me think that silver is going to outperform gold any second now. And that's why I think they're both going to rise, because this was basically a gold and silver rise, and then another rise, and then I think it's going to do another rise very soon. And that's why it's hanging out at the bottom of this channel. Here's the gold to platinum ratio. This is a clear break to the downside. We see the pullback here. We had a pullback today as well. Well, actually, it's probably about the same, so it's probably going to be flat for this ratio. But it's still extremely cheap. It still means that platinum is outperforming gold. That's what a declining move is here, and the breakout of this pattern. And we should continue to see platinum outperform gold. And I would expect this to drop quite a bit over time. Platinum is still a good buy at the moment because 1.8 is still a very cheap ratio for platinum. This is platinum to palladium. One thing I wanted to point out is platinum outperforms when it goes up when I have it set like this. Platinum's outperforming palladium and it broke out of its downtrend. That means that I would expect platinum to continue to outperform palladium in the future. That's what this ratio is telling us. It also tells us that platinum is extremely cheap to palladium because palladium is usually half to a third the cost of platinum. We're going to do substitutions to use more platinum instead of palladium, and the green revolution future is going to use a lot more platinum, not palladium, I think. But short-term platinum and palladium are both going to be used in quite a bit amounts. This is gold to copper ratio. You can see this ratio really break down. That means copper's outperforming gold. And then we popped out of this channel here and it's back testing the top here. So more than likely, copper is going to continue to outperform gold. Or, I mean, maybe they'll go at the same speed and kind of this track sideways or something, but we'll monitor it. If it was a breakout and it's going to come back, that means gold's going to go higher. If this comes back into this chart panel and gold's going to outperform for a little while. That could be the case. We'll look at it next week and see what's going on. Here's gold to oil ratio. Clear break to the downside. That means oil is outperforming gold. It's kind of in a pause mode right now. It's not really doing much, just traveling sideways. Oil is extremely cheap at 41 barrels to 1 ounce of gold. So that means that oil is extremely cheap in relationship to gold. So it's still a buy. Now this is gold to natural gas ratio. It was at 11, which is kind of fairly valued. It's all the way back up to 19 right now. So natural gas has pulled back quite a bit. That might be one to look into in the near future if natural gas finds a bottom price-wise. This is the 10-year Treasury. We've been in a very nice upward movement. It means that we have inflation. People are selling their bonds, and the yields are going higher. Eventually, we're going to test this line right up here, this downtrend line, and if it breaks to the upside, that means yields are going a lot higher, at least the 10-year yield. Here's a US dollar index chart. I drew a chart pattern in here. It's coming down to the bottom. It's going to test this bottom of the pattern. We'll see what it does when it gets there. If it breaks out and goes to the downside, dollar's going lower. If it goes to the upside, obviously it's going to go higher. Now I zoomed in here just to see what it looks like through a different pattern, different charting stock charts here. We've got the downtrend here. It's coming down in this wedge pattern. So it's one to watch. We'll see which way this breaks. Typically, I think declining wedges, this is going to break to the upside, not the downside. But we'll see. This is one to watch. So that's the dollar right there. Next, this is housing starts. I just want to touch on real estate and housing starts. It's coming up. We got up to, this is 1.6 million, dropped down because of COVID, and now we're heading back higher. This is where inflation comes from, is housing starts. Housing starts, if you think of it, and I know a lot of people, they get in this inflation-deflation debate so much. Inflation comes from loaning money from the commercial banks into the system. That's our fractional reserve lending. 97% of that money comes from commercial banks being loaned into existence. It's 97%. Now, of that 97%, 50% of that comes from residential real estate loans. That's 50% of the loaning, of all the loaning from commercial banks. Housing starts are important to watch in an expansion phase because new homes have new loans against it. That means that the loan going against that house is 100% newly created money. So what you see on the housing starts, if you were to chart this all out, is that when housing starts go up in an expansion phase, it's always inflationary and you always see increasing interest rates. What we're seeing now is we're not necessarily in an expansion phase yet. 1.5 million, we're right at that spot. We're about to enter an expansion phase. The reason we need to enter an expansion phase is because we have a housing shortage of 3.8 million homes. We have to build above the 1.5 yearly demand, 3.8 million more homes. Those are going to need all new loans against those homes if people buy them with loans, which the majority of people do. That is where your inflation comes from. Because it's 50% of the commercial bank loans, and when they loan that money, it's 100% increase in money supply for that entire loan that goes to a new house, a brand new built house. Other loans will also increase if the majority of the existing homes also go up in price. So what we're seeing is existing house prices go up, which is going to drive new home starts. That's to tie this all together for our market conditions. And that's why we monitor real estate. We monitor real estate because if real estate's going higher, your home starts will go higher. If your home starts are going higher, inflation will go higher. Then you validate that against the 10 and 30-year Treasury yields. That's how we're validating it. And that's how we know the market conditions and where we're at inflation-wise. Eventually, this money is going to work its way through the system and cause consumer prices to go higher. That I don't use as an inflation gauge. I use the leading indicators to tell me if inflation's coming. If you guys like this content, please subscribe, click the thumbs up button, leave some comments, tell me what you guys want to learn. I'm willing to do whatever videos benefit the majority of people on the channel. Thanks for listening, and this is Finding Value.